The Wealth Equation podcast by Maurice L. Wilson reveals how to accelerate your wealth and secure more money, time, and freedom by leveraging the investment powers of real estate, entrepreneurship, the stock market, and more. Tune in as host Maurice L. Wilson, an engineer turned financial advisor, offers you a step-by-step formula to solve your wealth equation once and for all. Here's Maurice.
Okay, hello and welcome back to the Wealth Equation with your host, Maurice Wilson. Thank you for joining me on late notice for a number of you guys, just kind of getting settled into doing more events like this. We'll be doing this every Wednesday at 8 p.m., as long as the schedule allows. And just wanted to jump right in it. You see the headline, What the Billionaire Meltdown Teaches Everyday Investors. A lot going on right now in the media, and in more particularly in the markets. As I do my weekend research and just try to consume as much information as I can, came across a pretty startling headline. I think it was CNBC or CNN maybe. They were talking about how all these billionaires, tech billionaires in particular, had lost billions of dollars. Musk, Bezos, Gates. Well, Gates is no longer the CEO, but Gates. All these name brand billionaires lost a ton of money over the last 2 days as the administration implemented tariffs. And for a lot of people, that word seems pretty unacceptable. Remove the riff and put an X, right? Tariffs are just a fancy way of saying taxes. And without getting into any political arguments, because that is not what we do at the Wealth Equation. There's plenty of channels that talk politics. I am strictly about the money. Without getting into any of the rhetoric about is this what we should be doing or not doing, let's just break down what a tariff is. And a tariff is simply a tax on particular goods coming from a foreign country into the domestic economy, i.e. foreign goods that U.S. consumers pay for. They are a tool that's used to kind of arrive at a certain outcome when negotiating with another country. So what does that have to do with the price of tea? Or more importantly, what does that have to do with your 401k, IRA, and investment portfolio in general? And why would that cause all these billionaires to lose so much money over a 48-hour period? The answer is this. You have to understand earnings drive stock prices. So think of it like this. If you're looking to buy a business, do you want a business with low earnings or high earnings? Obviously, you want the one with high earnings because you're going to pay a certain amount for this investment or for this business. So you want to know that after you buy this business, it's turning out money. You aren't buying it just to, pound your chest and walk around and say you're a business owner. You're buying a business ostensibly to make money. So the price of that business, the price of what someone can sell their business to you, and the price you're willing to pay for it is driven by the earnings and profits. So imagine buying a business where business A has no taxes and business B has 25%, or just say taxes that are 2 times the price of an item. Obviously, the one with no taxes is going to be more valuable, have more profits, because taxes are negative against profits. What do I mean, Maurice? When you get your check, you have a top number, a middle number, and a bottom number. That middle number is taxes, right? So the smaller that middle number is, the more that bottom number is. So you want the job, you want the state, you want the government that has the least amount of taxes, and therefore you make more money. When taxes are introduced, particularly new taxes are introduced in the form of tariffs, they impact earnings immediately. And they're also an unexpected cost for that business. So if you're out shopping for a car, they have to come in and tell you, look, this car is now 25% higher, 50% higher, 100% higher. If you're buying alcohol, if you're buying certain items on the shelves, things made in China, things imported from Canada, things brought in from Europe, all those things cost more money. The reason why stocks drop is they've got to drop the price of what they can offer for that stock to reflect the new reality of higher taxes for the consumer. And what the consumer is going to do is the consumer is going to adjust their buying, right? So the consumer is going to buy less of a product or none of a product. Well, if a company is not selling its products, its services, more importantly, its products, then the price of that company has to reflect that reality. Think of it like this: you're shopping for a house and you find out there's a toxic pond in the back of that neighborhood, the runoff pond. Well, the price of those houses has to drop to reflect that reality, or they've got to fix that pond. And that's what happens with tariffs. So you introduce all these tariffs in the manner in which they were introduced. They were wide sweeping. They hit, if you guys saw the board, they hit every country possible, small countries in Africa, unknown countries in other parts of the world. And so this isn't just about billionaires losing money. This is about all of us losing money in the markets. So what do we do? Is this a temporary trend? Is this a bigger trend? I'm one to go with this being, it is what it is until something changes. I think a mistake that investors make, particularly in this particular period of our, let's just say country, we keep trying to not see what's in front of our eyes, right? So if the market's selling off, if tariffs are on the table, you have to assume that that is the direction we're headed in until something changes materially. So you have to play this market for what it is. So I wouldn't try to outthink the room. I wouldn't try to read between the lines. You have tariffs until tariffs are no longer there. So that can mean a number of different things. For a lot of people, that meant a lot of selling, right? Hedge funds have considered giving up on US stocks. I'm seeing headlines saying it's hard to even pick a stock right now because of this, new tax on all these different goods. And so a lot of this has created panic. Now, I can tell you my personal experience, what I'm seeing from my clients is that a lot of them are wanting to buy into the markets. And it's not a bad impulse, but I think what we need to do is look at how bad markets work. Because what you want to do is there are three emotions that drive investor behavior: panic, fear, and greed. I would say Thursday and Friday were panic. But we got to make sure that the greed, hey, the prices are low, let me get in, doesn't overtake good, sound investment principles. And so it's important that we understand how markets work. So what I want to do is I want to share a screen and just go down something that I put together for you guys here that I think is going to help with what we're doing. So bear with me for a second while I set this up. And get you guys something that I think is going to be really helpful. Just get this right here. Right. All right. So let's talk about how bad markets work. Hopefully everybody can see my screen. You should see how bad markets work in the top on there. So first, what markets do, bad markets. So bad markets are simply what you think they are. Good markets, everybody's happy. They're talking about what they own and how early they bought it, and how they're doing well. The financial influencers are all over Instagram talking about until now, Facebook, Meta, Nvidia, quantum computing, AI, whatnot. You'll know you're in a bad market because nobody's giving out stock tips. Nobody is pounding the street, if you will, about what they own and how smart they are. Everybody's getting quiet. They're getting fearful. So that's because markets are declining. So as this red line shows, the first phase of a bad market is the decline. It's literally like flushing the toilet and watching your money go round and round and ultimately down the drain. That's what it feels like. And that's what you've seen on Thursday and Friday. Then what happens is markets kind of stop falling. And this is what we call a market bottom. And so you'll hear that term, going around a lot. People are going to say, hey, after, the NASDAQ, which is the tech index, after it's gone down 20%, after the S&P 500, it's gone down roughly 14%, are we at a bottom in the market? Has the market stopped falling? And they'll debate that until it's either proven or for some reason we start to go back up and we don't know. The thing about market bottoms are determined in the rear view mirror. You don't know you hit the bottom until you're well away from the bottom. And a good way to think about it is you have a headache, you take some Advil or leave, and somewhere over the next 12 hours, probably shorter than that, hopefully, you realize that your head no longer hurts, but you can't quite pinpoint when it stopped hurting. That's how bottoms work. So after the market bottoms, things start to go up, and that's what we call a recovery. So bad markets work in three phases: the decline, one; market bottom, second; and then the recovery. So really, when you think about it, this does not look so bad. But it's important to know that markets do not move in clear, pretty straight lines. How markets really move is like this. So this zigzag motion, this is how markets work. This is how bottom works. And what I want to do is toggle over to a real life screen that I have for you guys. Let me go over here. And so this is the 08, 07, 08 bear market. Let me get my pencil out here. So this is where we are. So this is what they call the Great Recession. And what I want to point out is, all right, here is our market top, like you saw on the other screen. And then here's our decline, right? That's our decline. So you can see what I mean by markets do not just move in straight lines. So all along the way, you see that market going down, up, down, up, down, up, down, up, and they just keep going down and up until you finally hit this this kind of bottom, right? Now you'll notice that that bottom, it touches there for about a week, and then we're off to the races. So everybody's trying to guess that bottom, because if you can buy down there, then you're going to make a ton of money. It's important to note, though, that while waiting for that bottom, this market fell 55%. Let me put that in big print so you guys can see it. So the market fell 55% during this. So people lost, if you bought at the top, you lost half your money during that market decline. And that's really what gives me pause right now, because I'm hearing from a lot of people about buying the dip, about, hey, prices look really good. And they may indeed look really good on a relative basis. But remember what I said, we've introduced a new tax to the environment, right? You're a consumer now for Apple phones, Nike shoes, trying to think of things that are made overseas that are easy to identify. Any overseas products, your automotives, building materials out of Canada. Just, we have a global supply chain. Everything that was globally supplied to us, manufactured out of the country and brought in to fit into cars, to fit into the TVs, all of that now has a tax. So that's a cost input to your business. And so the stock price has to reflect that reality. So if the previous reality was, hey, my cost of production was really low because it was overseas and I didn't have a tax on my consumer, and the new reality is that I have a higher cost of production and then a tax on my consumer, then the stock price is probably not necessarily cheap compared to where it was before, because the previous stock price was based on a whole different reality. Your new reality may be much lower, right? And so we have to be careful. Just because you go between these 2 points, old reality, new reality, does not mean that the price is necessarily cheaper. Um, Something I want to point out here as well, I'm going to clean up this chart just a little bit here, get rid of some of these drawings, is that look how long it takes for this market to get back up to where it was before. Let me get rid of that, get rid of that. So I'm just going to put like a really easy straight line right here, right there. So look how long it takes for that market to get back. So you've got looks like this is about September 2007, you hit a top. We don't see that price again until February 2013. Okay. That's 6 years and some change. Well, yeah, almost 6 years anyway. Now, along the way, though, there is money being made. So people think, oh, it took the market, almost 6 years to recover coming out of the '08 recession. It took us 6 years to recover, but anybody that bought on the lows was making money over about 4 years of those 6 years. It takes about 2 years for it to decline from '07 to '09, right? But then for the next 4 years almost, it's making money. And that brings me over. Let's go over to my clean chart here. Let's go back to our chart here. Okay. So you want to be in on this recovery. And to be in on this recovery, you got to be smart about what you do during the market decline. And I'm not going to give you like when to buy. We can't do that. But what you at least want to do when the market is declining is be very thoughtful about what am I doing with my capital? How am I deploying my capital while the market is falling? We aren't trying to time the market. We're trying to be smart about when we put money to work in the market. And one of the ways of being smart is taking an economist's view or a business owner view of the stock market. As a business owner, the cost of doing business has increased dramatically. What is the right value for my business? And where should I begin to invest in this business as a potential buyer of this business? When you make those decisions correctly, not perfectly, right? You're going to be early. These little arrows here are examples of being early to the bottom, but eventually that market does bottom. If you can be correct, not perfect, then you'll begin to make a decent return coming out of these markets, because the whole way you make money is that you buy low, sell high, right? So everyone loses money in these markets, but not everyone makes money. And the way that happens is you buy low, sell high. So the deeper you buy into a market decline, the better chances you have of making money. I sent an email out to my clients, and really, I think just people who have signed up for my email list, talking about the Bank of America '08, how they operated in the Great Recession between 2007 and 2009. And Bank of America stock fell from $55 to $250 between September '07 and about February, 2009. Ken Lewis, who was the previous CEO of Bank of America, he's no longer there, but he was trying to instill confidence in the stock for people. So what he did was he came out, did a big press conference. I think it was early February '09 or late January. I don't have the exact date. I'm sure you guys can look it up. Stock was trading at about 480. He bought 200,000 shares. I remember I was sitting there. I was early in my career, and I'm like, okay, that's, he's really trying to inject confidence. Now we have to remember what's going on. This is back when people thought their money market funds were going to lose money. This is back when banks actually disappeared. Wachovia, mortgage companies disappeared countrywide. Insurance companies disappeared. I think AIG, right? Things that we thought would never happen. Fannie and Freddie had to get taken over. And so the market, the banking system, if you were, is getting bailed out. And this CEO is trying to inject confidence. So he puts out 200,000 shares at about 480 a share. A week later, Bank of America shares dropped to 250. So he instantly lost almost 50% of his roughly $1 million. But do you know a month later, it was at about 5 or 6. And then about 3 months later, it was at 10. A year later, it was at 15. So he tripled that $1 million in about a year. And that's simply because Bank of America stock bottomed at $2.50 roughly. So that bottom, it took a long time to get there, but he got in early on that bottom, somewhere around the way. He didn't time it perfectly, but he bought low. And Bank of America stock right now trades at about 37 a share. So 37 divided by 250, that's about 10, right? A little under 3. So he got about an 8x return on his money on that $1 million simply because he bought low. And that's what you want to do in this market. Let's stop sharing my screen right now and jump over here back to our streaming. So that's one of the lessons coming into this market. So you're watching all these billionaires lose money, right? You're hearing the hit, and be careful with the news, right? The news, people say, oh, the news, the headlines, they're lying to us, right? And what I mean by that is there's this distrust of the media. I get it. Push all that aside. Understand the fundamentals of news, okay? There's always been a headline, right? You always have to grab somebody's attention, you know. And so billionaires losing money is designed to grab your attention. The only problem is if you're losing money along with the billionaires, now it creates this sense of fear and panic. Hey, everybody's losing money. The rich are no longer getting richer, they're getting poorer, right? And so you start to feel this fear and this panic setting in with your portfolio. Um, so what do you do with that? Well, you want to remove the animal instinct and you want to look at how bad markets work. And remember, they work in 3 phases. First, there's the decline, then there's the bottom, then there's the recovery. Okay. Nobody knows how long each phase is, right? In 2007 through 2009, the market took from September 07 till about June, July of 09 to truly bottom out. In the dot-com crash, it took from about the summer of 2000 till about the fall of 2002 to truly stop falling. But those are some of the longest falls. Then you have the pandemic. The pandemic worked like this. On about by Valentine's Day, the market had topped. By St. Patrick's Day, Easter, it had bottomed and it had recovered. Then you had the 2022 inflation scare. That one took from January to October to stop falling, and it fell about 25%. Right now, if you're keeping track, the S&P 500, which is our big index, the one you hear about, you don't hear about it the most in terms of the number, but you hear it. People usually report on the Dow Jones because the numbers are easy to report on. But the S&P 500, which is what most investment professionals like me follow, is down roughly 12 to 14%. The NASDAQ is down roughly 20%. And I think the small cap index, known as the Russell 2000, is down about as much as the NASDAQ. So you're getting that decline. Now, how much further that goes, you can take what's called an educated guess. For me, I'm looking at saying, okay, business has fundamentally changed. How low does the market need to go to price those businesses properly? I don't know if 10 to 20% off the market is enough, particularly when you consider that the price is already high to begin with. So for me, and I'm trying not to give you guys advice that gets us in trouble. But what you want to do is you want to be careful with your capital here. There are ways to extend your capital here. There are ways to increase your exposure without laying out too much of your capital, but you want to protect your capital here and not be worried about getting the lowest price, but concerned with getting good lower prices. During the 2020 pandemic, um, I was buying in and around the lowest price of a particular security that we use here. And one of my colleagues, we were tracking this thing really closely, and it had dropped to a certain number. And this number would be, in hindsight, remember the rear view mirror, was going to be the market bottom. And I said, no, 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 I'm looking for something much lower. I was being greedy. I wanted something much lower. Turns out that was the bottom. Next thing we know, the market's recovering and we're off to the races. Um, so I'm saying that story to say, okay, I was trying to get a certain price point instead of being concerned with getting certain prices. So you want to take a look at what you're investing in. If it's Nike, if it's Nvidia, if it's Apple, if it's Chipotle Grill, if it's Meta, take a look at that business. Say, okay, how's this business being impacted by tariffs? Just this business alone, right? I'm not worried about the overall market. And how do I fairly value that, right? And then what are the prices that I'm trying to get in on, and how much am I going to put to work at those prices? If you do that, if you focus on not getting scared, if you focus on being smart with your capital, you can't guarantee you're going to do well when this thing is over, but you will have stuck with a strategy that did not let you succumb to headlines about billionaires losing money and people running around talking about it's a 201k, not a 401k, or they'll come out and say capitalism is dead and all these other headlines. You want to have your strategy in place. And investing is really simple. I mean, when you back out the emotions, investing is really simple. You are simply looking to buy low and sell high. That's it, and not sell low, right? So when things are going lower and you've lost money on paper, you've got to kind of say, okay, is this still a good investment, right? When people lost, when the home values went down in '07 and '08, did you run out and sell your home? Well, no. And if you had, shame on you, because we know what happens next. I mean, home prices were never as low as they were in recent history, this decade, I would say, this century, really, as they were during the '07, '08 crisis, right? They've never been that low again. We all know about the housing crisis that we have now. So if you saw your home value go down and rushed out and sold it and blah, 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 then you made a mistake. Don't make that type of mistake. Be smart about your assets, value your assets. And there are so many tools out there that you can use that I can't name here, but I can talk to you about if we get in a conversation one-on-one, or if you join my email list. So that's a plug for my email list, The Wealth Equation. If you visit my site or shoot me an email at maurice@wilsonwealth.com, I am happy to put you on a mailing list where we're talking about these particular things on an ongoing basis to help you become more proficient at managing your wealth. That's maurice@wilsonwealth.com. You can also go to my website and sign up, wilsonwealth.com. And get on our email list. Let's start a conversation where I can really look at your situation, hop on a Zoom call, and really drill down at what's going on with your portfolio, your 401k, and help you to navigate this madness that's going on out here. So again, if I had to wrap up, I would say, hey, the headlines are really wild right now. And what grabbed my attention was that the billionaires had lost $50 billion, in 48 hours, Thursday and Friday. And what does that mean for you? I mean, because we always say, hey, the rich are getting richer. These guys are geniuses. But one, it means that, hey, they lose money like you. If you're going to call somebody the richest person in the world, they're basing that on what we know they own. So in Elon Musk's case, he owns about 12% of Tesla. A lot of people think it's a lot higher. It's not as high as you think. We know how much of Berkshire Hathaway Warren Buffett owns. We know how much of Meta Zuckerberg owns, Bezos. And so when those stocks fall in value, we can say, hey, on paper, you lost, several $billion. But in this case, so did we, right? We're all investing in these same companies. So what does that mean for you? What are you going to do about it? Well, understand again how bad markets work. And we're in a bad market, okay? And bad markets work in three phases: decline, bottom, recovery. How you set yourself up, how you conduct yourself and your capital during that market decline will determine how well you do in that recovery. Stocks are on sale. Are they cheap enough? If they aren't cheap enough, what are you going to do? How can you put some of your money to work at certain prices to make sure you don't miss out? Little questions like that are what you want to stick with when you see these headlines. And don't panic. Don't try to predict the end of the world. If it's the end of the world, folks, it doesn't matter what's in your portfolio, right? I kind of hate when people come at that. Well, the dollar's going to be worth this. And all right, if that's the case, then it doesn't matter, right? We all become hunters and gatherers again. So the worst case scenario will take care of itself. Really, when you think about it, the worst case scenario is that the world doesn't end and we get to sit back and look at what you did. What did you do during the last declines are going to determine your prosperity after the decline. So again, that's all I have for right now. I don't know if we're taking Q&A today, but if you do have a question, definitely join my email list. You can find it at maurice@wilsonwealth.com. You can also, I just realized I didn't have the slides in full screen mode, so I apologize if it wasn't set up properly. You can also sign up for my newsletter at bit.ly/Wealth Equation News. You can also email me at maurice@wilsonwealth.com, and you can also visit our website. We put a lot of money into it. Please come out and check it out at wilsonwealth.com. And so thank you for joining me on such short notice. Again, visit us. We'll be here every Wednesday talking about the markets and personal finance. Thank you very much.
It is a pleasure to have you join us for this episode of The Wealth Equation. Be sure to visit wilsonwealth.com for more information about building wealth. We look forward to helping you next time on The Wealth Equation.